Imagine checking your brokerage account at like 9:30 on a Tuesday morning.
Oh yeah, just sipping your coffee, checking the market.
Right. And you see that a company's net income has suddenly, inexplicably, exploded by 168% overnight.
I mean, your immediate instinct is probably to assume they just, cured a disease or something.
Or maybe they invented some revolutionary new technology, right? You figure the underlying business has fundamentally transformed.
Right, you're looking for that huge catalyst.
Exactly. But what if I told you that massive spike had absolutely nothing to do with selling their core product, and it was actually all about a quiet geopolitical legal loophole?
It's exactly the kind of anomaly that says algorithmic trading bots on fire.
Oh, absolutely.
While leaving, fundamental analysts scrambling to figure out if the numbers on the screen are even real.
Yeah, and that is exactly why we are here today. So welcome to a special Talk Tickers edition of The Deep Dive.
Glad to be here.
Our mission today is laser focused. We are ripping apart the Q2 2026 earnings call of Karat Packaging.
Ticker symbol KRT for those following along.
Right, KRT. If you are holding this stock, or if that 168% income jump caught your eye on a stock screener this morning, you really need to understand what is happening under the hood here.
Because it's complicated.
It really is. So we're going to extract the raw data, translate all that Wall Street executive jargon, and give you an actionable data-forward verdict on whether this is a buy, a hold, or frankly, a trap.
And we really have to do this because the financial landscape Karat is navigating right now is, well, it's incredibly murky.
Yeah, to put it mildly.
We aren't just looking at a company that sells paper cups and plastic containers.
Right.
We are looking at an operation that is actively trying to survive a completely chaotic global supply chain.
Oh, the supply chain stuff is wild right now.
Plus, brutal spikes in diesel fuel, shifting consumer mandates for eco-friendly materials, and on top of all that, a massive, completely unexpected cash injection from the federal government.
Yeah, that government cash injection is definitely the elephant in the room here.
A huge elephant.
So let's trace that money immediately. Let's look at the headline numbers that dropped in this Q2 report because they are genuinely eye-popping.
They really are.
Net sales hit a record, $136.3 million.
Wow.
Which is up 9.9% year over year. Net income, as we mentioned, just surged 168.3%.
29.6 million, right?
Yes, exactly. And diluted earnings per share, the golden EPS metric that literally every retail investor watches, it came in at $1.46.
Which is just massive.
To put that in perspective, in the exact same quarter last year, their EPS was 54 cents.
Right. So on paper, it looks like a flawless operational victory.
It totally does.
I mean, an EPS jumping from 54 cents to $1.46, that's the kind of metric that guarantees a stock will completely dominate the morning financial shows.
Right. But I look at those numbers and my alarm bells are just deafening.
Yeah, for sure.
Growth like that in a mature physical goods industry like packaging, it just doesn't happen organically in a single quarter.
No. It defies the physics of the industry.
Exactly. I don't see a sudden tripling of business efficiency here. I see an illusion. I see a dam release.
A dam release is actually the perfect metaphor for this.
So before anyone hits the buy button thinking this company has discovered some magical new profit margin, we have to talk about the IEEPA tariff refund.
Right, the IEEPA refund.
Right. What exactly is this mechanism, and what is it hiding in this quarterly report?
Well, like you said, it's a dam release, because this isn't recurring revenue we're talking about here.
It's not operations.
No, it's trapped capital that just suddenly broke loose. So IEEPA stands for the International Emergency Economic Powers Act. It's a federal statute that grants the U.S. president broad authority to regulate international commerce, in response to extraordinary threats.
Right.
And over the last several years, under various administrations, tariffs were heavily levied on imported goods.
Especially from regions where Karat historically sourced their materials, right?
Exactly. Particularly Asia.
And just to clarify the mechanics for a second here, because I think people get confused by this. When those tariffs are enacted, a company like Karat doesn't get to just pass a magical bill to their customers.
Oh, no,
They are the importer of record. they have to actually pay those tariffs directly to Customs and Border Protection just to get their containers out of the port.
Precisely. They have to tie up their own working capitals to pay those duties up front.
Which is brutal for cash flow.
It really is.
Yeah.
So for previous quarters, Karat just absorbed those significant tariff costs. It was this massive drag on their profitability.
Holding back their margins like water behind a dam.
Exactly. But in Q2 of 2026, the legal landscape surrounding specific exemptions shifted. Ah, okay. And Karat received a massive refund on those previously paid tariffs. The government essentially opened the floodgates.
And how much money are we talking about here?
This single non-recurring event washed $25.8 million directly into their adjusted EBITDA for the quarter.
$25.8 million in one single quarter for a company that did $136 million in total sales.
It completely warps the P&L.
It distorts it beyond recognition, honestly, if you aren't paying close attention.
Let's break down that $1.46 earnings per share number because this is wild.
Let's do it.
If you run the math on that $25.8 million injection, a full dollar of that $1.46 EPS was purely generated by the tariff refund.
Wait, a full dollar?
One full dollar.
So if we subtract the government check, their actual real-world operational EPS for the quarter was 46 cents.
Mathematically, yes. 46 cents.
Wow.
Now, comparing that 46 cents directly to last year's 54 cents requires a bit of nuance.
Right, because last year had its own issues.
Yeah, because last year they were actively being penalized by those tariffs in real time, which was dragging their numbers down.
Sure, that makes sense.
But the core operational truth you are highlighting is exactly what investors need to hear today.
Which is that you cannot extrapolate that $1.46 into future quarters.
You absolutely cannot. It is a one-time windfall.
And this extends directly to their margins, too, which is where things get really dangerous for the casual observer.
Oh, the gross margin is deceptive here.
Right, because the reported gross margin for Q2 was 56.6%.
Which is insane for packaging.
Yeah. If you see a physical packaging company pulling a 56% gross margin, you assume they have an absolute monopoly.
Or they're selling software.
Right. But again, that includes a 1,890 basis point contribution purely from the government refund.
Yeah. And to her credit, when their CFO, John Guo, walked through the reconciliation on the call, she smartly stripped out that refund.
Which management always should do to show the underlying health of the business.
Exactly. So without the government check, the ex-refund gross margin, the actual spread they made on sourcing, moving, and selling physical products was 37.7%.
Now, I have to push back here.
Okay.
Because this is where the rubber meets the road for the fundamental investor listening right now. The headline margin drops from 56% way down to 37.7% once we remove the noise.
Right.
My initial instinct is that 37% sounds kind of low, especially when they're dealing with all the inflationary pressures we are about to discuss.
It might sound low compared to tech, sure.
So in the reality of the commoditized packaging sector, is the 37.7% gross margin actually a sign of a healthy business? Or is it vulnerability?
Honestly, it is an incredibly strong indicator of health.
Really?
Yeah, and here's why. You have to understand the specific physics of the packaging industry.
Okay, unpack that for me.
Like we said, they are not selling proprietary software with near zero marginal distribution costs.
Right, no cloud downloads here.
They are selling physical commodities, paper, plastic, resin. Furthermore, they are shipping products that are mostly empty space.
Empty space? Like what?
Think about it. A shipping container full of unnested paper cups is predominantly just air.
Oh, wow. Yeah, I didn't even think about that.
Which means their freight costs relative to the actual value of the good are extraordinarily high.
That makes total sense.
So to maintain a gross margin approaching 40% while physically moving these low-density items across the globe in a volatile freight environment, it proves that their core pricing power and their supply chain management are elite.
Okay, so what you're saying is the tariff refund made them look like a software company for a quarter, but their baseline 37.7% margin confirms they are an absolute powerhouse in the physical logistics space.
Exactly. They aren't some struggling business propped up by a government check.
Right.
They are a fundamentally robust business whose numbers were just temporarily exaggerated by a regulatory victory.
Which perfectly transitions us to the actual recurring operations of the company.
Because that's where the real story is.
Because if the bottom line explosion was mostly a mirage, that $136.3 million in net sales was very real.
Very real. Physical boxes moving.
Exactly. That 9.9% top line growth wasn't a tariff refund. That was physical product moving out the door.
Yeah.
So we need to figure out what drove that organic sales growth, because the story behind the numbers is fascinating.
Management is clearly executing a massive pivot right now.
Let's look at the positive drivers first. And the undisputed star of this report is their e-commerce channel.
Oh, e-commerce is fundamentally rewriting Karat's entire growth narrative.
Give me the numbers on that.
Online sales grew by 23.6% year over year.
Nice.
Hitting 25.8 million for the quarter.
Wow.
It now accounts for nearly 19% of their total net sales.
Now, 19% might not sound like a revolution to someone who's used to evaluating tech stocks.
Sure.
But we have to contextualize this for the packaging sector. Historically, a company like Karat makes its money through massive broadline distributors.
Right. Think of the giant food service delivery trucks pulling up to national restaurant chains.
Exactly. They lock in multi-year contracts, they ship pallets by the thousands, and they give massive, massive volume discounts.
Huge discounts.
So the fact that nearly a fifth of their revenue is now coming through online channels represents a total shift in who they're actually selling to.
It's a massive shift. It's moving from enterprise reliance to capturing the long tail of the market.
Right.
And the momentum is accelerating rapidly.
Yeah.
CEO Alan Yu didn't just give the Q2 numbers on the call. He actually provided a real-time July update.
Oh, I love when they do that.
Yeah, he noted that in July, overall online sales growth accelerated past 37%.
Wow.
But the most staggering metric was their performance on Amazon specifically.
What happened on Amazon?
Sales jumped by 49% year over year.
Wait, hold on. A 49% jump on Amazon for bulk packaging.
Yeah.
Let's trace the mechanics of that, because this isn't a national burger chain negotiating a contract.
Definitely not.
This implies that independent coffee shop owners, regional bakeries, food truck operators, they are literally opening the Amazon app on their phones at midnight to order takeout containers and paper bags.
That is exactly what is happening. The procurement behavior of small to medium businesses, the SMBs, it has permanently changed.
Since when?
Really, since the pandemic era supply shocks. Traditional distributors often prioritized their massive enterprise clients back then.
Right, leaving the independent restaurants scrambling for basic supplies like cups and bags.
Exactly. So those independent operators turned to Amazon just to survive.
And they realize it's actually easier.
Much easier. They realized the user experience, the search visibility, and the delivery speed were vastly superior to calling up some regional sales rep.
That makes a ton of sense.
And Karat aggressively leaned into that behavioral shift. They optimized their SKUs for Amazon's algorithms, and they are now capturing that fragmented, high-volume market.
But I have to ask about the unit economics here.
Okay, let's hear it.
Because Amazon famously takes a massive cut.
They do.
They charge fulfillment fees, storage fees, referral fees. If Karat is shifting volume toward Amazon, isn't Amazon just eating all their margin?
That's a fair question.
How does a 49% increase in Amazon sales actually benefit Karat's bottom line?
It comes down to net pricing power.
Okay.
Yes, Amazon takes a significant fee. However, selling direct to small business via online platforms commands a vastly higher baseline price than what Karat has to offer a national distributor.
I see.
When you sell 10 million cups to a massive distributor, they demand a razor-thin wholesale price.
Because of the volume.
Right. But when a coffee shop buys 3 cases of cups on Amazon, they are paying near retail prices.
Right, they don't have the leverage.
Exactly. So even after Amazon extracts its fulfillment fees, Karat's net margin on that direct transaction is often structurally higher than the margin on a massive, highly discounted distributor contract.
That is a brilliant piece of operational leverage.
It really is.
They bypass the distributor's pricing chokehold by utilizing Amazon's logistics infrastructure to reach the end user directly.
Yep. And it's clearly working because the CEO explicitly stated their target of hitting $100 million in online revenue for the year is firmly on track.
Man, $100 million just online.
It is on track, and, it is being heavily supported by a massive shift in product mix, too.
What do you mean by product mix?
Well, it's not just how they are selling, it's what they are selling. Their eco-friendly product line is surging.
Oh, right.
It now makes up 33.8% of all sales, up from 31.8% in the same quarter last year.
And we see this every day as consumers.
Yeah,
right?
that's where you go.
The plastic bag has essentially vanished from the takeout ecosystem, replaced by those heavy-duty handled brown paper bags.
Exactly.
But as an investor, I always view these eco-friendly initiatives with a healthy dose of skepticism.
Sure, greenwashing is a real thing.
Right. Is this aggressive shift into paper products actually a smart financial strategy? Or is this just corporate PR to look good on an ESG report?
Oh, it is a vital financial necessity.
Really?
Yes, driven by regulatory mandates and raw material volatility.
Explain the volatility part.
The traditional plastic packaging industry is highly dependent on resin. Resin is a petrochemical derivative,
Okay.
which means its underlying cost is handcuffed to the global price of oil.
So when crude oil spikes, resin costs spike.
Exactly, and the margins of plastic manufacturers get immediately compressed.
So by pivoting heavily into paper bags and compostable materials, they are actively decoupling their cost structure from the geopolitical volatility of oil markets.
Precisely. Now, paper has its own raw material dynamics. Pulp prices fluctuate,
Right.
but it diversifies their supply chain risk. More importantly, though, this is a compliance-driven demand surge.
Compliance-driven, meaning the laws are changing.
Exactly. States and municipalities across the country are legally banning single-use plastics.
Right, you literally can't hand out a plastic bag in half of California anymore.
Exactly. So restaurants aren't switching to paper bags just because they want to. They are switching because they have to by law.
That's guaranteed demand.
It is. Karat is expanding their eco-friendly SUs specifically to capture that mandated non-discretionary demand.
Okay, so the top line story is incredibly compelling. The e-commerce engine is firing. They are capturing the high-margin long tail on Amazon, and they are successfully front-running the regulatory shift toward eco-friendly packaging.
Right. That's the bull case.
That is a strong bull case. Now, we have to look at the macro headwinds.
Yeah, because it wasn't all good news.
No, this earnings report wasn't all sunshine. The broader economic environment is actively trying to crush this company's margins.
It really is.
Let's dig into the costs, because this is where the real stress test happens.
The cost structure is under severe pressure right now. Let's look at their import costs first.
Okay.
Import costs rose to 11.1% of net sales, up from 9.5% last year.
Now, a 1.6% variance might seem trivial to a casual observer.
But it's not.
Right, because on $136 million in revenue, that represents millions of dollars in eroded profitability directly hitting the gross margin.
And the culprit for that erosion is something completely outside of their control.
Which is?
Average container rates spiked by 8.9%.
Ouch.
They are literally paying almost 10% more just to secure a metal box on a cargo ship.
And the financial bleeding didn't stop once that ship arrived at the port either.
No, it didn't.
Let's talk about the domestic side. Their selling general and administrative expenses, the SG&A, took a massive hit, driven by a $3.1 million increase in shipping costs.
That SG&A line item was heavily scrutinized by analysts on the call, specifically by an analyst from William Blair. And it's important to note the sequencing here.
Okay.
Well, CFO John Guo had to clarify that these shipping and transportation expenses didn't just rise year over year.
Oh.
They rose sequentially by $1.4 million just from the first quarter to the second quarter of this year.
Just quarter over quarter.
Yes, that indicates an escalating immediate problem.
And CEO Alan Yu did not mince words about what caused it.
No, he was very direct.
He bluntly stated that the second quarter saw the highest fuel costs they've experienced in the past year. Diesel fuel peaked at a brutal $5.40 per gallon.
And he directly attributed that peak to the ongoing geopolitical instability in the Middle East.
Right.
It is a stark reminder of the physical realities of their business model.
Yeah, everything is connected.
A geopolitical conflict disrupts global oil supplies, which spikes diesel prices in the domestic U.S. market.
And then what happened?
Suddenly, the cost for a third-party logistics company to put a pallet of Karat's paper bags on an 18-wheeler and drive it from a port in California to a warehouse in Illinois skyrockets.
Because of the fuel.
Right. And those third-party carriers pass those costs directly to Karat in the form of massive fuel surcharges, which immediately devours their SG&A.
See, this is exactly where I get critical of management teams.
How so?
Wall Street notoriously punishes companies that just sit there and absorb macroeconomic shocks.
Oh, absolutely.
If your freight costs go up, you cannot just shrug your shoulders on an earnings call and say, well, diesel is expensive right now.
You have to have a plan.
You have to deploy a mitigation strategy. You have to fight back. So how is Karat actually stopping the bleeding here? What is the operational pivot to defend that 37.7% margin?
Well, this is arguably the most impressive part of the report.
Let's hear it.
Management isn't just absorbing the costs. They have deployed a highly aggressive, two-pronged defense strategy to fundamentally re-engineer their supply chain.
Okay, two prongs. What's the first?
The first prong is localized logistics control.
Trace the mechanics of this logistics pivot for me, because this feels like the crucial variable for the rest of the fiscal year.
So first, they are expanding their physical footprint strategically. They are finalizing a lease for a 47,000 square foot facility in Orlando, Florida.
Why Orlando?
This isn't just about needing extra storage space for inventory overflow. This is about optimizing routing.
Okay.
The Southeast is currently their fourth largest online market.
Right.
Historically, if a customer in Miami ordered supplies, Karat was likely servicing that order by shipping it out of a distribution center in South Carolina, or worse, Houston, Texas.
Which takes 3 to 5 transit days.
Exactly.
And if you are relying on Amazon for 49% of your e-commerce growth, you are dealing with customers who have been conditioned to expect prime delivery speeds.
Yes, 2-day shipping is the baseline now.
Telling a restaurant owner they have to wait 5 days for essential takeout containers is a massive competitive vulnerability.
Precisely. By placing a node directly in Orlando, the CEO noted they can offer next day or at worst, 2-day delivery to the entire Southeast region.
That's huge.
It collapses the delivery timeline and significantly reduces the total miles driven per order.
Which saves on fuel.
Yes. But the physical warehouse is only half the strategy.
What's the other half?
The truly disruptive move is how they are choosing to move the freight.
Okay.
To bypass those incredibly expensive third-party carriers who are hitting them with those $5.40 fuel surcharges.
Yeah.
Karat is aggressively expanding its own internal fleet.
No, wait. I have to challenge this strategy.
I figured you might.
Operating an internal trucking fleet is notoriously difficult and capital intensive.
It is.
You have driver retention issues, commercial insurance spikes, truck maintenance, and the sheer logistical nightmare of optimizing routes.
It's a lot of overhead.
Companies like Amazon and FedEx spend billions of dollars on algorithms just to make their fleets break even. Are we really supposed to believe that a mid-cap packaging company can efficiently run an internal trucking network without burning through massive amounts of cash?
It's a very valid skepticism.
Yeah.
But you have to distinguish between running a national freight network and running a localized arterial system.
What's the difference in this context?
Karat isn't trying to build a long-haul network from New York to LA.
Okay.
They are using their internal fleet for 2 highly specific, highly controllable functions.
Which are?
First, localized final mile delivery directly to major customers within the immediate radius of their regional warehouses.
Okay, that makes sense.
Second, and more importantly, they're using their own trucks for inter-warehouse inventory transfers.
So they are just shuttling inventory between their own buildings.
Exactly. Instead of paying a massive premium to a third-party logistics company to reposition excess inventory from Houston to Orlando.
They just do it themselves on their own schedule.
Right. They can optimize the loadouts, ensure the trucks are never running empty, and completely eliminate the profit margin that a third-party carrier would normally extract from them.
Interesting.
It requires upfront capital, yes, but in a volatile fuel environment, it gives them absolute control over their internal cost structure.
Okay, I see the logic there. They are building a closed-loop system for their heaviest traffic lanes.
Yeah.
So that's prong 1. Taking control of regional logistics. What is the second prong of their defense strategy?
Sourcing. They have executed a radical de-risking of their global supply chain.
How so?
This is honestly a masterclass in adapting to the realities of modern geopolitics. For decades, the standard playbook for the packaging industry was to rely heavily on mainland China for cheap manufacturing and tooling.
Right, everyone did that.
But Karat has aggressively diversified away from that single point of failure.
Right.
In this quarter, sourcing from China accounted for just 11% of their total requirements.
11%.
Crazy, right?
That is an incredibly low exposure rate. for a company that imports manufactured plastics and molded paper products.
Yeah.
How did they achieve that, and where is the volume actually coming from now?
Well, this didn't happen overnight.
No, it couldn't have.
Ripping a supply chain out of China requires years of identifying new factory partners, retooling molds, auditing facilities for quality control.
Securing new export logistics.
Exactly. They have successfully shifted the bulk of their volume to Taiwan, which now accounts for a massive 46% of their sourcing.
Okay.
Furthermore, they are aggressively leaning into domestic manufacturing. Sourcing from within the United States has increased to nearly 20% of their total requirements.
And the rest.
The remainder is distributed across a mix of strategic locations like Indonesia, Singapore, and South America.
The mechanics of that diversification are brilliant.
Which is very smart.
By intentionally spreading their manufacturing footprint across Taiwan, the US, and South America, they're essentially buying an operational insurance policy. If a trade war erupts, or a port strike shuts down Indonesian exports, or new tariffs are levied on a specific country, Karat isn't paralyzed.
Not at all.
They can simply throttle down orders in the affected region and immediately ramp up production in another. It creates structural resilience.
Resilience is exactly what they have engineered, and this brings us back to your earlier point about the gross margin.
The 37.7%.
Right. This strategic sourcing shift away from China, combined with the deployment of their internal logistics fleet, is exactly how they managed to post a 37.7% core gross margin while getting hammered by higher container rates and expensive diesel.
Wow.
They didn't just survive the macroeconomic storm, they fundamentally upgraded the ship while sailing through it.
So we've established that the Q2 execution was impressive once you strip away the tariff noise.
Very impressive.
But if you're evaluating this stock for a portfolio, you don't buy equity for what a company accomplished yesterday. You buy it for what they're going to do tomorrow.
Exactly. Forward-looking.
Let's transition to management guidance. What exactly are they projecting for Q3 and the remainder of fiscal year 2026?
The forward-looking guidance provided by management is what I would categorize as cautiously optimistic, yet highly disciplined.
What are the numbers?
For Q3, they are projecting net sales to continue growing in the low double-digit range.
Okay, so 10 to 12% maybe?
Right. This signals that they expect the strong momentum from Q2, particularly that 37% overall online surge they witnessed in July, to sustain itself right through the fall.
But the real question is about profitability.
Always.
Because without that $25.8 million tariff dam release artificially inflating the numbers, the Q3 margins are going to look vastly different on the actual earnings release, correct?
They will look drastically different, and management was very transparent about resetting expectations here.
Good.
CFO Zhang Guo guided for a normalized gross margin in Q3 to land between 35% and 37%.
Okay.
Correspondingly, they project an adjusted EBITDA margin in the 9% to 11% range.
I can already see the reaction from retail investors who don't read the transcripts.
Oh, the panic selling.
They are going to see a 56% gross margin in Q2, and then they are going to see 35% in Q3, and they're going to panic. They are going to assume the company's pricing power completely collapsed.
Which is precisely why our analysis today is so critical. A drop from 56% to 35% is not an operational collapse. It is a return to their baseline reality.
Right.
And it's important to note that for the full year 2026, management expects the blended gross margin to average out in the low 40s.
Because that massive Q2 tariff refund will lift the 12-month mathematical average.
Exactly.
Okay, so the headline margins are going to mathematically compress in Q3. The algorithms might even flag it as a negative momentum trend.
Probably.
But as I read through the Q&A section of the earnings call transcript, I noticed two massive, almost stealthy catalysts setting up for the second half of the year.
Oh, the macro tailwinds.
Yes, these are macroeconomic tailwinds that management doesn't control, but that are going to act like a gravity assist for that 35 to 37% core margin.
The macro tailwinds are shifting significantly in their favor. Let's break those down. What is the first catalyst you identified?
Currency exchange rates.
Oh, yes.
We just spent time detailing how they successfully moved 46% of their supply chain to Taiwan.
Right.
When you are importing almost half your goods from a single foreign nation, your cost of goods sold is entirely at the mercy of foreign exchange markets.
Completely.
And CEO Alan Yu noted on the call that they're currently experiencing a massive tailwind from a strong US dollar against the Taiwan dollar.
The mechanical impact of that currency dynamic cannot be overstated, especially when you look at the historical context here.
What happened last year?
Last year during Q2, the US dollar was weak relative to Taiwan.
Okay.
That meant Karat's purchasing power plummeted. They had to spend more US dollars to acquire the exact same amount of raw materials.
That's a direct hit to margins.
In fact, it was so severe last year that they had to record a $2.9 million foreign currency transaction loss on their P&L. It was a massive headwind.
But today, the script is completely flipped.
Totally flipped.
The US dollar has strengthened significantly against the Taiwan dollar. That means every single US dollar Karat deploys right now, buys more paper, more plastic, and more finished packaging out of those Taiwanese factories.
Exactly.
Their fundamental raw material costs have mathematically decreased simply because of the macro currency markets.
And the beauty of a currency tailwind is that it flows flawlessly to the bottom line.
Zero effort required.
It requires zero operational effort for management. It just naturally enhances the gross margin on every product imported from that region.
That's incredible.
But that is only the first stealth catalyst. What did you highlight as the second?
The reversal in fuel costs.
Yes.
We talked about how brutal the $3.1 million SG&A hit was in Q2, driven by diesel peaking at $5.40 a gallon.
Right.
But management provided a crucial real-time update. The CEO explicitly stated that as they entered Q3, diesel costs had already plummeted by roughly 25%.
Dropping down into the $4 range.
Exactly.
The timing of that drop is incredible for their operational leverage. Think about the sequence of events here.
Okay.
They deliberately built out an internal logistics fleet and signed a lease for a massive Orlando distribution center specifically to fight $5.40 diesel and expensive third-party carriers.
Right, they built it for the peak pain.
They built the infrastructure for a worst-case scenario. Now, the macro environment has eased, and they get to operate that hyper-efficient, localized fleet on $4 diesel.
The margin expansion potential there is just phenomenal.
It really is.
And it's not just their internal fleet that benefits. The exorbitant fuel surcharges that third-party ocean freighters and domestic rail carriers were levying on them in Q2, those will also legally have to decline as global oil and diesel indices cool down.
So when you synthesize all these data points, the narrative for the second half of the year becomes very clear.
Right.
The underlying unit economics, the actual physical cost to manufacture a compostable cup in Taiwan, pay the ocean freight to get it to a port in Florida, and drive it on an internal truck to a customer in Orlando, they are getting significantly cheaper across the board.
The currency exchange is acting as a multiplier.
Fuel costs are dropping.
And the structural efficiencies of their internal shipping network are firmly locked in.
It's an incredibly powerful setup, and it becomes even more compelling when you look at the revenue pipeline they are feeding into this optimized system.
Oh, right, the new accounts.
Because it's not just e-commerce growth. Management confirmed they successfully landed 4 new chain accounts during the second quarter.
4 new enterprise chain accounts represent significant volume.
Huge volume.
Right.
But the life cycle of onboarding clients of that magnitude is critical to understand here.
Right, because when a national chain signs a contract, you don't just start shipping them product the next day.
No, you have to run custom molds, print their logos, manufacture all the inventory.
And physically position it in regional distribution centers.
Exactly. It takes months.
So when does that revenue actually show up?
The CEO indicated that the inventory ramp-up phase is occurring right now. The actual recognizable revenue and product shipments for those 4 new accounts are scheduled to turn on and hit the income statement in the fourth quarter.
So if we connect all these dots for the investor, Karat is compressing their cost structure in Q3 through currency and fuel advantages, while simultaneously loading massive new revenue streams into the chamber, ready to fire in Q4.
That's the setup.
This is the definition of a catalyst-rich environment, which brings us perfectly to our final section, the bottom line.
Time for the verdict.
We promised our listeners an actionable Talk Tickers verdict. Based on the data, the macro environment, and the strategic pivots, is this a bullish or bearish signal for the stock?
Before we render our final verdicts, it is imperative to look at how management views their own execution, and the purest metric for that is shareholder yield.
Okay, let's talk about the yield.
How is the company actively returning capital to the people who own the stock?
And Karat is returning capital very aggressively. They announced a hike to their regular quarterly dividend, bringing it to 47 cents per share.
A dividend hike is perhaps the most reliable signal of management's internal confidence.
Right, because executives do not raise the dividend yield if their internal projections show cash flow drying up or margins collapsing in the near future.
Exactly. They only commit to that recurring payout if they are certain the underlying business can actually support it. But they didn't stop at the dividend.
No, they also deployed capital for share repurchases. During the quarter, they actively bought back $2 million worth of their own stock.
Which was specifically 73,510 shares.
Right. And they made sure to note on the call that they still have $10 million in authorized capital left in the chamber for future buybacks under the current program.
From a capital allocation standpoint, they are executing a classic value investor playbook.
They really are.
They are paying you a rich dividend just to hold the equity, while simultaneously buying up shares on the open market to reduce the overall float.
And reducing the float, theoretically, increases the fundamental value and EPS of your reigning shares.
Exactly.
Okay, we have analyzed the macro headwinds, the micro execution, the tariff anomalies, and the capital returns. It is time for the verdict.
Let's deliver on our promise.
What is your definitive stance on Karat Packaging?
My stance is decisively bullish.
Decisively.
Yes, specifically predicated on their operational resilience. What this Q2 report proved to me is that Karat's management team is highly adaptable.
They really seem to be.
They can navigate severe, multifaceted supply chain shocks, whether it's geopolitical fuel spikes, exploding container rates, or inflationary pressures, and still protect a highly respectable 37.7% core margin.
You're completely ignoring the $25.8 million tariff refund in your thesis, though.
Completely. I view the refund as pure noise. The true signal is the baseline margin and their ability to strategically pivot away from China. Furthermore, the stickiness of their e-commerce growth is the most compelling aspect of their future valuation.
Amazon numbers.
That 49% surge in Amazon sales is not a pandemic-era fluke. It represents a permanent structural shift in how small and medium businesses procure their operational supplies.
Which gives them a better baseline.
Exactly. It provides Karat with a higher margin, highly predictable revenue base moving forward. They have successfully decoupled their growth from a reliance on a handful of massive, margin-squeezing corporate clients.
Well, I am fully aligned with your bullish sentiment regarding their operational execution.
It's hard not to be.
The strategic pivots are masterful. However, as the resident translator for the retail investor, I am obligated to attach a massive flashing warning label to this stock.
Okay, what's the warning?
My stance is this. Buy Karat Packaging for the steady, low double-digit organic growth. Buy it for their expanding footprint in the high-margin e-commerce space. Buy it for the rich, growing dividend yield and the shareholder-friendly capital allocation.
That all sounds bullish, but what is the warning?
You absolutely not anchor your forward expectations to Q2's reported 56% gross margin or that $1.46 EPS.
Oh, yeah.
If you enter this position expecting them to magically generate nearly $1.50 in earnings per share every single quarter, you are going to get slaughtered when Q3 earnings drop.
The market will punish that expectation.
Right. That Q2 print was a one-time anomaly driven by a literal act of government intervention. You have to intellectually model this company based on their 37% core margin and their 46-cent operational EPS.
Which is still good.
It is. If you can do the math and you find the valuation attractive at those normalized real-world levels, then yes, this is an incredibly strong operator worth holding.
It requires extreme emotional and analytical discipline from the investor. You have to actively ignore the flashy, algorithmic headline numbers and place your trust entirely in the boring underlying mechanics of their localized supply chain.
Exactly. You have to look past the packaging and see the logistics.
Right.
Which actually leads me directly to a final thought I want to leave you, our listener, with today.
Oh, I like where this is going.
I want to give you a thesis to mull over that wasn't explicitly stated on the earnings call, but is hiding in plain sight within everything we just spent this deep dive discussing.
I love a good structural theory. Based on the data, what are you seeing that Wall Street might be missing?
Look at the sheer volume of strategic infrastructure Karat is quietly building.
Okay.
They're standing up regional distribution centers, like the massive 47,000 square foot node in Orlando.
Right.
They're taking final mile delivery and localized routing into their own hands by aggressively scaling an internal trucking fleet.
Yeah.
They have developed the software and the operational muscle to handle their own complex inter-warehouse logistics. They've successfully nearshored their supply chain, diversifying away from China, and building resilience across Taiwan and the U.S. during a period of peak global chaos.
So they aren't just relying on third parties anymore. They are systematically building a highly controlled, closed-loop logistical system.
Exactly. So here is the provocative question I want you to explore as you research the stock further.
Let's hear it.
Is Karat Packaging quietly transforming from a simple packaging vendor, a company that merely manufactures plastic cups and paper bags, into a vertically integrated logistics company?
Wow.
Because if management is actively building the infrastructure to not just manufacture the eco-friendly cup, but to warehouse that cup in localized hubs, route it via their own algorithms, truck it on their own internal fleet, and deliver it next day to an independent coffee shop, they are playing a totally different game than their competitors.
They are building a massive economic moat.
And if they are successfully becoming a localized logistics powerhouse in disguise, how long until the broader market stops pricing their stock like a boring, low multiple packaging company and starts pricing them with the premium valuation of a supply chain innovator?
That is a phenomenal lens to view this through.
Right.
The physical infrastructure and routing capabilities they are building just to service their own needs today could very easily become a standalone logistics service they monetize tomorrow.
Exactly.
It absolutely warrants keeping a very close eye on their capital expenditures and fleet expansion metrics over the next few quarters. If they keep investing in trucks and regional warehouses, your theory might just become their primary business model.
It is exactly why you have to read the transcripts and why you have to look beyond the headline noise. The muddy waters of this Q2 earnings report might actually be hiding one of the most interesting business transformations in the sector. Thank you all for joining us on this deep dive into Karat Packaging. We've stripped away the tariff noise, traced the supply chain shifts, and hopefully given you a much clearer X-ray of the operational reality under the hood. Keep doing your homework, keep questioning the algorithmic headlines, and we will see you on the next deep dive.